Hey Puppy Trades! In this video, we're going to go over the top 3 weekly dividend paying ETFs that beat the S&P 500 when they are blindly averaged into. Number 3 is YMAX. YMAX is a fund of funds. Basically, what it's going to do is it's going to own all of the YIELDS covered call ETFs, all of these ETFs right here. It's going to own all of these ETFs equal weight, and we can see that by looking at the current holdings. It's going to own all of these YieldMax ETFs equal weight, and it's going to pay a weekly dividend to the tune of 71%. Now, a lot of people think that you can't get dividends. You can't get dividends without sacrificing performance, and there is NAV erosion on these ETFs. But with the NAV erosion and with the premiums that are going to be received, we actually see when we go to the total return calculator that YieldMax is going to beat the S&P 500 when YMax is blindly averaged into. It achieves a 16.32% annualized return. Past performance does not equal future results, but we're going to see on the exact same time frame that's going to beat the S&P 500 by about 3%. So that's pretty good for a 71% yielding weekly ETF. Another big thing about this is that it's got a pretty big diversification aspect to it. It's going to be owning exposure to all of these different companies. We can see Airbnb, AI, AMD, Amazon, Apple, Alibaba, Coinbase, Carvana, Disney, Facebook, the gold mining ETF, Google, JP Morgan, Marathon Patent Group, Moderna, Microsoft, MicroStrategy, Netflix, Nvidia, all of ARK, Palantir, PayPal, Supermicro Computer, Snowflake, Tesla, Taiwan Semiconductors, ExxonMobil, Square, and Ybit, which is Bitcoin. So it's going to be pretty diversified. Yes, it's more tilted towards growth than value, but that's going to beat the S&P 500, and it's going to get a 71% yield. And it's pretty diversified. It's pretty anchored to the stock market. It's pretty anchored towards this high beta tech sector that we see, and it beats the S&P 500. That's a lot different than this ETF number 2. Number 2 is LFGY. It yields slightly lower, only 60%. It pays a weekly dividend, and what this is going to do is it's going to invest in the crypto industry and tech portfolio. It's actually going to be owning these stocks outright, and then it's going to be selling options. We can see Coinbase and MicroStrategy are the biggest holdings. The Bitcoin ETF, Marathon Patent Group, Robinhood, Hut, Core Scientific, even Tesla is in this ETF. Mercado Libre and Riot Platforms are the top holdings. It's then going to be selling options against those holdings. So that's going to be capping the upside. What's really interesting about this ETF is the total return destroys the S&P 500 when averaged into this ETF since its inception. We can see that there is a 64% total annualized return. Now that's with crypto, so there's going to be more risk, but that's going to destroy the S&P 500 of a 24% yield. So a lot of people would look at the chart of LFGY and they're just going to talk about NAV erosion, but the truth is that LFGY is doubling, is more than doubling the performance of averaging into the S&P 500. So that's very interesting. It has an expense ratio of 0.99, which is lower than YMAX's expense ratio of 1.28. That's because YMAX is a fund of funds. It's going to be owning funds that already have a 0.99% expense ratio, and so then there's a 0.29% management fee on top of that. But this ETF is going to have a higher beta. It's going to be more tethered to Bitcoin than the stock market. It's actually going to be owning the companies outright, which is different than YMAX, and it's also different than the number one ETF on this list. Now, the number one ETF on this list is YBTC. It has a much lower yield than the previous two, but the performance is pretty incredible. It's tethered to Bitcoin, and so what this is going to do is that it's going to be very similar to YieldMax. It's going to use options to get its exposure. It's going to use put options and call options. It looks like they're using the 53 strike call and the 53 strike put to gain their notional exposure to Bitcoin. Let me make sure I have that right. Yes, the 53 strike put is being sold. The 53 strike call is being bought. What that's going to do is that there's going to be a 50 delta to the upside, and then they're selling the put, so that's a negative on the negative delta. A negative and a negative make a positive, so that's going to be a positive delta of 100. We're going to see that that is going to be how they're getting their 100 delta, and then they're going to be selling out of the money call options against that delta. We can see the upside cap right here is that they have about a 5% upside cap selling the 62 strike call on IBIT, and then they're selling the call on the Bitcoin mini futures. So they're using futures and IBIT to get their exposure. And what this is doing is it's going to yield 29%, which is much lower than the previous two. The performance is pretty incredible. Blindly averaging into YBTC, I'm going to figure that out by going to the ETF total return calculator, going the same amount of investment each time, and then over a year's worth of performance, we see a 43% annualized return. That's very good, and it's going to beat the S&P 500 by over triple the total annualized return. So a lot of people think you can't get dividends without sacrificing performance. These three ETFs show that is certainly not true. This is not investment advice, but these are the top three weekly paying dividends. So it's possible to get a weekly dividend and beat the S&P 500. And with YMAX, it's even possible to be exposed to basically the top stocks in the S&P 500 and still win with the dividend.